Welcome back to Anna's Capital, the place where we break down the world of money, markets, and global power in a way that actually makes sense. This past week has been intense. War tensions are shaking markets, billion-dollar deals are shifting global influence, and some decisions happening behind closed doors could impact your wallet more than you think. Today, we're diving into the 10 biggest financial and geopolitical stories of the week, explained simply, but with real insight. Let's get into it. 1. Stock markets drop as war fears rise. Global stock markets fell sharply this week, with major indices entering correction territory as geopolitical tensions escalated in the Middle East. Investors hate uncertainty, and war creates exactly that: uncertainty about oil, trade routes, inflation, and political stability. Here's the key issue. When conflict escalates, money moves out of risky assets like stocks and into safe havens like gold or government bonds. But what's more interesting is why this drop feels different. Markets aren't just reacting to war, they're reacting to the possibility that this conflict could drag on and disrupt global supply chains. My take? This isn't panic selling. This is strategic repositioning. Smart money is preparing for a longer period of instability. 2. Oil prices surge as Middle East tensions escalate. Oil prices jumped significantly as fears grew about supply disruptions in key regions. This matters because oil is the foundation of the global economy. When oil rises, everything becomes more expensive: transportation, food, production. But here's the deeper layer. Higher oil prices can reignite inflation, which central banks thought they had under control. That means interest rates could stay higher for longer. In my view, this is one of the most underestimated risks right now. People think inflation is done. It's not. 3. Federal Reserve warns about inflation. Impact officials from the Federal Reserve expressed concern that war could push inflation expectations higher again. This is critical. Central banks don't just fight inflation, they fight expectations of inflation. If people believe prices will rise, they act differently. Businesses raise prices faster, workers demand higher wages. That's how inflation becomes self-reinforcing. My perspective? The Fed is trapped. If they cut rates too soon, inflation returns. If they keep rates high, they risk slowing the economy. 4. Insider trading fears around policy decisions. Suspiciously well-timed trades before major U.S. policy announcements are now under scrutiny. Some traders made millions just before decisions on tariffs and geopolitical moves. This raises a serious question. Is information leaking? Markets rely on fairness. If insiders have an advantage, trust breaks down. And here's my honest take. This kind of behavior isn't new, but it's becoming more visible. And that's dangerous for confidence in the system. 5. Wall Street bonuses hit record levels. Wall Street bonuses reached a record $49.2 billion. Yes, during a time of global uncertainty, financial elites are earning more than ever. This tells us something important. Volatility is profitable for those who know how to navigate it. Banks thrive on trading activity, deal-making, and market swings. My view? This widening gap between financial elites and everyday people will become a major political issue in the coming years. 6. BlackRock CEO earns Trijeshi Sheetam, $7 million. The CEO of the world's largest asset manager received massive compensation after a strong year. This reflects the growing power of large asset managers in global finance. Companies like BlackRock don't just invest, they influence markets, governments, and even ESG policies. Here's the deeper insight. We're moving into a world where capital concentration equals power, and that power is becoming increasingly centralized. 7. Global trade tensions resurface. Trade negotiations between major economies remain stuck, particularly around digital trade rules and tariffs. This may sound technical, but it has real consequences. Trade conflicts slow global growth, increase costs, and create uncertainty for businesses. What's interesting is that we're seeing a shift from globalization to fragmentation. Countries are becoming more protective, more strategic. My take? The era of free global trade is slowly ending. 8. Big tech under pressure again. Major tech stocks continue to face pressure as investors question high valuations and AI spending. For years, tech was the unstoppable engine of the market. Now, investors are asking, are these companies overinvesting in AI? That's a big shift. Markets are no longer blindly optimistic. They're demanding results. My perspective, this is healthy. It marks a transition from hype to reality. 9. Banking sector faces legal and regulatory pressure. Major banks are dealing with lawsuits, fines, and regulatory scrutiny. For example, settlements and legal cases continue to cost banks millions. This highlights a broader trend. Regulators are becoming more aggressive. After years of loose oversight, the pendulum is swinging back. My view, the banking sector is entering a more controlled, less profitable era. 10. Global economy shows signs of stress. Consumer sentiment in the U.S. dropped to a 3-month low amid inflation fears and geopolitical tensions. Consumer confidence is one of the best indicators of economic health. When people feel uncertain, they spend less. And when spending drops, the economy slows. This is the beginning of a potential shift, not a crash, but a cooling. My take? We're entering a phase of slower, more fragile growth. So, what does all of this mean? We're entering a world where geopolitics drives markets more than ever before. War, trade conflicts, and political decisions are no longer background noise. They are the main story. If you want to understand money today, you have to understand power. If you enjoyed this breakdown, subscribe to Anna's Capital. Because we don't just follow the news, we explain what it really means. Bonus: quick insight. Here's a fascinating detail. Prediction markets, platforms where people bet on future events, are seeing a surge in activity tied to geopolitical outcomes. That means people are literally betting money on war scenarios. It's a strange but powerful signal of how financialized the world has become.